We left the ruler at home, so. Well, good morning, everyone, and welcome to HamCo's June meeting, where we are happy to be hosting a top lender panel. So we've got some of our industry's brightest and best here to share wisdom, knowledge, and opinions, honestly. So I feel the need to wish anybody in the audience or at home a happy anniversary. In the last week, I have seen probably 20 anniversary celebrations. So apparently June was, now I think it's all about the fall and everything's getting moved to the spring because of COVID. But I guess back in the day, June was the time to get married. So happy anniversary. Welcome to our meeting. Thank you for being here. I know it's an extremely busy and stressful time in our industry still. It appears that there's a little bit more inventory hitting the market based on seeing a couple more purchase agreements come our way. But just keep grinding, keep taking care of each other and, fighting for our clients here. So with that, we're going to jump right into the meeting content since we've got 4 panelists here today. Our gold sponsor right off the bat is Caliber Home Loans. Caliber Home Loans is a nationwide mortgage company that closed over $80 billion worth of mortgage loans in 2020, combining the nationwide reach and capabilities with that of a local hometown feel. Get to know your local Caliber loan officers today. Moving right along, our platinum sponsor for the day is Meridian Title Company. And if we could welcome Shelly Hartman to the stage here.
Thank you for that nice warm welcome. I appreciate it. So as you all know, wire fraud continues to be the #1 threat in the real estate industry. Cybersecurity attacks and real estate transactions are real and they're attempted frequently. Meridian Title has an obligation to protect the consumer's money. In addition to receiving wiring instructions verbally or by phone, picking up a copy at one of our offices, we have added a text option and an email option. To have your wiring instructions emailed, we use a third-party company called Certify ID. A link is sent via text or email to the consumer with a secure personal verification process. Once confirmed, Meridian Title's wiring instructions can then be emailed through Certify ID portal directly to the consumer. Certify ID charges $4.95 for this service, and the charge is then added to the settlement statement. This method is fast, easy, and most importantly, secure. Consumers are aware of wire fraud attempts in our industry and their transactions, and with their transactions, they are wanting reassurance they won't be victim. For more information regarding Certify ID, there is a flyer at my booth or at our table out here, or you can reach out to a Meridian Title representative who can talk to you and your consumer, and they'll talk them through the process. The cost of Certify ID is nothing compared to the loss of someone's life savings to a cyber attack. And we do have a giveaway today. If somebody can tell me what the name of the company is that we use to send send their wiring instructions securely, you'll win our prize. I said it 3 times, Jay. Yay! Thank you.
Thank you so much, Shelly, and thank you, Meridian Title, for being a longtime HamCo sponsor. I think at least 10 years, if not longer. So thank you so much. And I'm hearing that we're struggling to hear at home. Can I do one more sound check? Can people hear at home?
I can hear you.
Okay, I see a thumbs up, so we're going to keep moving right along here. All right, and our first announcement, Gabby Benson with the Realtor Foundation. I don't think I see you on the call. So we are going to move right along. Andrew Huber, our favorite MyBoard liaison, take it away.
Good morning, HamCo. All right, this one I'm especially excited because this is just for the HamCo people. In late April, the Mybor Economic and Community Development Council, or the ECDC, invested $10,000 into the White River Vision Plan. Who here knows about the White River Vision Plan? Look it up. It's very, very exciting. We are finally making an asset out of the White River in Central Indiana. Anyways, because of this investment, Realtor members get the opportunity to sign up for an on-water rafting workshop right here in Hamilton County on June 29th from 8:30 a.m. until 11 a.m. The workshop will help Realtor members not only learn about the White River and the White River Vision Plan, but create long-term stewards of the river. Join your peers for a morning on the water in your community. And if you'd like to sign up for the Realtor White River Raft workshops, please see Mybor employee Maddie Rathstetter right here in case you're interested. Maddie, could you stand up? Everybody say hi to Maddie. Maddie's new at Mybor, and what's your title, Maddie? Be loud so everyone at home can hear you too. Hey, welcome, Maddie. Cool. So if you're interested in that, talk to Maddie Rathstetter. As you may know, Mybor dues are due July 1st and cover the period of July 1, 2021 to June 30th, 2022. You may make your payment directly from the email invoice that we sent to you guys on May 24th or through the info hub from the Mybor dashboard. Mybor is a member-driven organization, just like the divisions. Mybor all the way to the very top, our Mybor board of directors is all Mybor member-driven. This October, voting will begin to elect a new Mybor board of directors for District 1, which is just the north side, the northern quadrant of Marion County, District 3, which is southern Marion County, Johnson County, and Brown County, and the affiliate position, which is all affiliates in Mybor. Are you the visionary leader who will work to ensure that Mybor continues to empower members and strengthen the marketplace? Those wishing to run for an open seat should complete a director candidate profile sheet by June 28th, 2021. I know what you guys might be thinking. Why are you telling me this if we are in Hamilton County, which is District 6? Because this is a very, very important organization. This is the Mybor Board of Directors. This is the authority and what happens at Mybor, and we need the best and the brightest to represent us at that table. So if you or you know somebody who's in those areas, I'm talking Northern Marion County, Southern Marion County, Johnson, Brown, or an affiliate, encourage them to run, encourage them to lead. That's the best thing about Mybor, is that we are member driven. The people in the front lines are the same people in the back rooms making the big policy decisions that affect all of us in our industry moving forward. So please, 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 if you know somebody, encourage them to step up. Talk to Zach Miller. He's a board of director. He has experienced it. He'll set the expectations for you. Like I said, June 28th, what is that, guys? 4 days from now, it's locked in. And then the rest of us in October will begin voting for these leaders. June 28th, director candidate profile sheet. If you've been a member of Mybor for at least 2 years and are ready to become a leader, then REAL is the perfect opportunity for you. The Real Estate Academy of Leadership, or REAL program, is taking place for the 21-22 class year, and applications are open until June 30th. Program sessions will be in person. Right? This is like the sweetest word said these days. To learn more details about the program and what to expect, go to mybor.com/real. And if you're ready to start your path towards leadership, go check it out today. I know I'm preaching to the choir here, but do REAL, all right? And if you're unsure about it, talk to someone who has been in REAL. Sorry, guys, I know I do this every week. Show of hands, who's been in REAL? All right, so if you're wondering, talk to someone who had their hand up, all right? Don't talk to me, I'm gonna tell you to do it. Talk to one of these people for a real description on what the expectations are. This month's episode of Leave Your Shoes by the Door, Mybor's podcast, features Realtor Tyler Hankins. Check it out at mybor.com/podcast or wherever you get your podcasts. And if you like what you hear, be sure to subscribe. Did you know that the Century Key app can do so much more than just open a lockbox? Join us today from 10 a.m. to 11 a.m. for a live webinar presented by Century Lock just for us, the Mybor members. You'll learn how to use the Century Key features, including agent safety, key missing alerts, showing instructions, property resource integrations with other BLC tools like HomeSnap, RPR, and Remind, listing agent contact information, and a whole lot more. You can register now for these and all of the classes that we offer to our members by going to the BLC dashboard and clicking on event registration. The Mybor BLC is in contract negotiations with a leading showing service provider with the intention of offering a high service, white glove showing service as a member benefit associated with your BLC technology package. What I'm saying in simpler terms is we're getting our own showing service, and it will not increase your dues. It's all part of your BLC package. So we're now going to have our own in-house showing service, and you can expect that to be implemented in Q3, going into Q4. So this fall, we're getting our own showing service. Come on, let's get excited for that, right? Autonomy. All right. Realtor Action Day is coming up on July 16th. RAD was created to provide MyBoard Realtor members with the opportunity to give back to their communities through placemaking and quality of life projects, and to help encourage volunteerism across the MyBoard region. On RAD, realtors will volunteer at 9 different locations, making a notable and combined impact within our communities. Stay tuned for your opportunity to plug in on a project. More info is available at myboard.com/ECDC, and I bet Maddie Restetter could help you with any questions you have on that as well. So if you want to get your hands dirty for your community, this is your opportunity. It's all happening on July 16th. So make sure you go to myboard.com/ECDC and find a cool project that interests you somewhere in central Indiana. Your professional services department has a wealth of information to share either during a division meeting or during a brokerage meeting. All things professionalism, from common ethics violations and statistics to best practices and transactions, MyBoard staff can present either in person or virtually. Just contact them at professionalservices@myboard.com. All right, this next one. So when I go to a restaurant and I order a cheeseburger, they bring the cheeseburger out. It's probably going to have tomatoes on it. I'm not a big fan of tomatoes on cheeseburgers, but doggone it, I invested in that cheeseburger. So go ahead and bring the tomatoes out, and maybe my wife will eat it. Your investment to your membership of MyBoard should be no exception. All right, you pay your MyBoard dues for the whole package. So make sure that you are getting the most out of it. And let us tell you what the resources we offer by going to myboard.com/value. Now you're here right now. So you are, the MyBoard divisions are a perk of your membership with MyBoard. So you're getting the most out of your investment right now, but there's so many other things that we offer our members. So make sure you go to myboard.com/value. Hey, you get the most out of your cheeseburger. All right. And this next one, this is another personal life, Andrew Huber. You guys know MyBoard, Andrew. This is personal life, Andrew. I was in Carmel a few weekends ago. Like when a band names your town, you don't like clap, right? Like, I love you, Indianapolis. No? All right. Anyways, I was in Carmel and I was at that Sun King thing. What would you guys call that? Just a community space Sun King thing? And I look at my coworker, Sierra, and it's just like, this place is amazing. Let's do something with this. So MyBoard Next will be hosting the all summer no bummer meetup at the Sun King right there in Carmel on July 8th from 2 p.m. to 4 p.m. Come as you are. We're not having a speaker. There's no registration. Just come as you are. It's awesome. A show of hands, who's been there? Right, oh, you guys know, you guys live here. So we need to get people from the other counties to see the awesomeness that is that Sun King setup right here in Carmel. Walk the path and just the walkability, and it's just awesome. So we're gonna be there, but if you do go, if you could bring a box or 3 of Kleenex, because we are partnering with an organization called Teachers Treasures. They provide a free store for teacher supplies that's located on 10th Street. We asked them what they needed, and they need Kleenex. So if you do come on July 8th from 2 p.m. to 4 p.m., please bring at least 1 box of Kleenex to help out our teachers as they go back to school this fall. All right, going into RPAC, if you're not at the table, then you're on the menu. This statement couldn't be truer when it comes to protecting your industry and home ownership and strengthening our communities. RPAC has your back. Are you doing your part? $15 is all it takes to become an RPAC investor. With RPAC, you're supporting advocacy efforts that ensured that we were deemed essential during 2020, holding the line on real estate taxes and fees, and are pushing for crucial attainable housing across the region. RPAC did that. Invest today at myboard.com/RPAC or via your dues bill. Go to RPAC, all right? Read what RPAC does for me, you, our industry. It's not a donation. You are investing in RPAC. You're investing in the betterment of our industry. Go to myboard.com/RPAC. Let's talk about partying, right? We're going back to in-person, so you know our industry's partying. This month License to Thrill, a party for the Realtor Foundation, is coming July 23rd to Silo Auto Club. Grab your black sunglasses and have your martini shaken, not stirred, with this James Bond inspired night of fun and networking to benefit the foundation's mission, which is linking hope to homelessness. The event features food stations and drinks, awesome entertainment, music and fun games, tours of the Silo car collection, a ride simulator, race face-off, silent auction, and a whole lot more. Tickets are $40 and are on sale now at realtorfoundation.org. Boy, I know I said a lot of stuff to you guys today, but If anything I said piqued your interest, I'm sitting right here in the front row and I'm not going anywhere. We'll figure it out together. And now I'm going to introduce the District 6 representative, Zach Miller. Zach, you're up.
Hey, good morning, everybody. Not much to add. Andrew always does such a good job of the headlines coming out of my board, but just a couple of things. Last week, the board of directors, we did have our annual retreat, and a lot of really good stuff is coming your way. Not just the in-house showing service, but a lot of exciting stuff that I think is really going to help us address what some of the things that we're experiencing in the industry right now. So again, be excited for September, October, because it's going to be really good. Speaking of lockbox training that Andrew spoke about, this is a recent thing that has come up that it just kind of caught us a little off guard. But as you know, Century Lock is going away from using the cards at the end of the year. So you will no longer be able to use your cards. Because of that, Century Lock has stopped manufacturing the cards. So new members are not getting cards. I know it's very common for those of us who have been in the industry for a while to maybe unload some of our lockbox inventory if we're going to get new lockboxes and sell them to brand new agents coming into the industry. Guys, they don't have cards. They cannot take ownership of the lock boxes without a card. It's just the way that Century Lock is set up. We have talked with Century Lock. There is no workaround. So if you are going to sell your lock boxes to anyone, make sure that they have a card so that they can take ownership. The only way that you can take ownership of a lockbox without a card is if you have the most up-to-date Century Lock, which is the white Bluetooth box. That's the only way someone can take ownership without a card. So if it's one of the ancient silver ones or one of the almost ancient blue ones, you have to have a card. So just a reminder on that. Again, district elections, for the most part, what's going to apply to the folks in here is that affiliate seat. We have a lot of strong affiliates in this room who are leaders. Come and talk to me if you're interested in running for the board of directors. I highly encourage it. We need your voice on the board of directors. And again, real, you have, what is today? Today's the 24th, so you have 6 days? Yeah, 6 days to get in your real application. Again, if you have not been through real, if you have not applied for real, or if you have applied for real but have not gotten in, keep going, keep trying. It is so worthwhile. You are going to learn so much. So Real Academy, yeah, just apply, do it. Like Andrew said, just do it. It's awesome. I think that's it. So thanks, guys.
All right, so with that, we are ready to get to our meeting topic. Right off the bat, can we give these gentlemen and women a round of applause here? These are top producers and leaders in the mortgage business, and we are so lucky. They could be sitting at their desk writing a million loans right now, but they're taking an hour and a half to sit here with us. So thank you so much right off the bat. With that, our first panelist is Julie Bowering from Elements Financial Credit Union. She is an Indiana University at South Bend alumni, where she got her bachelor's in elementary education. Any good loan officer or realtor could tell you that comes in handy.
It sure does.
Because reading emails is hard sometimes. 23 years in the mortgage business. She started in 1998. She currently is the vice president of mortgage lending with Elements, where she oversees sales, operations, lending risk, secondary market, and lending technology. Last year, Elements funded $580 million with only 15 loan officers and 17 operations employees. They're the #1 credit union, bank, financial institution, and conventional loans in the Indianapolis area in 2020. Her husband, Dave, and her live in Cicero. They have 1 son, 2 daughters, 3 grandchildren, and 2 dogs. Julie, thank you so much for being here.
Thank you. Happy to be here.
We'll go right down the line here. The next one, Jason Kinney with Bailey and Wood Financial Group. He has 15 years in the mortgage business. He currently holds the title of branch manager and sales manager for Bailey and Wood Financial Group on the north side. His office is located in Noblesville. He's a little bit unique because he's worked in 3 different areas of lending. He's worked as a broker with a bank and also as a direct lender. So before mortgages, a little fun fact here, Jason Kinney worked for HBO Sports and CBS Sports in New York City. So don't let Noblesville fool you. He's a big city guy. He's married to his wife, Jen, for 11 years, and they have 2 daughters, Kara and Kylie, and he's a big family man. So Jason, thank you so much for being here this morning. Thank you. Next, we have Mike Wickham with Caliber Home Loans. He's a Ball State University grad. He has 16 years in the mortgage business. Currently, he's a sales manager and mortgage consultant for Caliber Home Loans Indy North office. And last year in 2020, Mike funded $77 million worth of mortgage loans, including both purchase and refinance. He has made Caliber's Circle of Excellence every single year since 2012, and in 2014, he was HamCo's Affiliate of the Year. He has been involved with HamCo as a board member or as a platinum sponsor since 2013. Mike's been married to his wife, Leslie, for 10 years, and they have 2 twin 6.5-year-old boys, Max and Jace. Mike, thank you so much for being here this morning. And last but certainly not least, we have Jay Tolliver with American Mortgage here with us this morning. He's bragging about 23 years in the mortgage business. Currently is a branch manager and sales manager for American Mortgage, where he oversees Carmel, Greenwood, and Avon. Year in and year out, he's a top 10 originator in the company and also a Chairman's Club Award winner year in and year out. Over a decade of MIBOR and HamCo involvement, he's won awards such as HamCo's Affiliate of the Year, HamCo's Distinguished Service Award, and HamCo's Bud Tucker Award. So I think next he's going to get his real estate license and go for Realtor of the Year. He's married to his wife, Catherine, and they have twins, Ren and Ruby. 2 sets of originators up here with twins. Ren is obsessed with, or actually, Ruby loves horses and sports cars just like her daddy. Ren is obsessed with Lion Guard and is quite accomplished with reading and writing Braille, as he is blind due to a rare genetic condition called Batten disease. They've learned to make lemonade out of lemons and have learned to enjoy every single day with a unique perspective. So Jay, thank you so much for being here. So now that we've met our lending experts, it's time to reintroduce Zach Miller, the Realtor, who will be grilling these loan officers on what's going on in the industry. Zach Miller is a Ball State University grad. He has 15 years of real estate experience. He currently serves as the branch manager for FC Tucker's Zionsville office. He is a member of FC Tucker's President's Club. And I need to take a deep breath before this next line. He's the immediate past chair of HamCo. He's the current District 6 director. He is the MIBOR RPAC chairman. He's a board member of Indiana Association of Realtors Board of Directors, and he's an Indiana representative for the National Association of Realtors. So I have no idea how he finds any time to spend with his husband, Justin. They've been together over 21 years and married for 7 of those. And they have 3 dachshunds. If you've ever seen the word dachshund spelled out, it kind of messes with your head. And they have 3 of them, Marcus, Max, and Malcolm. So Zach, get up here and let's kick this panel off.
I was harassing Chris that it is not Dash Hound. So thank you for inviting me to moderate. I've had interactions with, I think, most of this panel up here, and I can tell you that all 4 of them are exceptional at what they do. So thank you all for taking your time out of your, I know, crazy business to be here. So I'm going to start with ladies first. Julie, first question is, what is one thing you've changed in your business specifically due to COVID, and will any of those changes be permanent?
Yeah, so I can definitely speak to that. We definitely become more virtual with everything that we're doing with our members and clients. So our goal is to make it easy to do business with us. So really just continue to make investments in technology and making it super easy for people to do business with us and interact with our team.
Excellent. Jason.
Raise that question one more time.
You're all good. Hey, what is one thing or anything that you have changed in your business specifically due to COVID, and are any of those changes going to be permanent?
So definitely, make sure this works. So definitely the technology part, just kind of learning to interact with people through either Zoom or the other technology platforms has been definitely a change, and it's actually very efficient. We can reach more people, we can get more tasks done as opposed to jumping in a car and meeting somebody or them coming to our office and what have you. So we've definitely tweaked our technology platforms to conform to the new COVID. The thing is, I don't want to continue down that road of doing that permanently, but because I'm a belly-to-belly guy, I'm old school. I love meeting people and connecting with people. So, but that's definitely one thing that, and as everybody on this panel can attest to, we all probably had our best years in 2020. And I think a lot of that has to do with just the way we can crank out loans and not have to more efficiently. But it becomes less impersonal. So that's the one downside that I really, don't enjoy. So.
Absolutely. Thanks. Mike?
Does it work? I would say a lot of the same as both have mentioned, dealing with Zoom and FaceTime and texting and all the other capabilities that we've all had to adapt to, and embracing that technology instead of running away from it more than ever. I don't think I did a Zoom call before the pandemic, but getting on that bandwagon to jump on that and embrace it, and using also the e-closing and some of the changes that our industry has made with technology has been a challenge at times, but getting through it, but just continue to evolve and use all those tools as good as we can.
Absolutely. Jay?
Technology, same answer basically. So we've always, for a long time, had the ability to e-sign disclosure packages. I utilized it where it needed to be utilized before, utilized it a lot more last year than this year. But like Jason, I'm a face-to-face guy, especially with first-time buyers. That opportunity to sit down and go through those disclosures with them is a really good opportunity to go through some highlight points to make sure that their process goes smoother, to make sure that questions are answered, and that some things are really clear for them and that they're more comfortable. So it's hard to replace that, especially with first-time buyers. So I think that we're all probably a little bit more comfortable with technology. I think the pandemic helped some people pick up some tech skills, which is not a bad thing. So it's made people more comfortable with things that they just didn't need to try before. But it has its place. It's efficient, but I'm looking forward to getting back to true normal. I don't really want to embrace a new normal. So.
Yeah, absolutely. I think we can all agree that no matter who you are in this industry, whether you're a realtor, a lender, title, inspections, anything that goes with this industry, we are all face to face. We're a pretty gregarious bunch, I think. So I couldn't agree more that while the technology has been wonderful, I'm just ready to see people for myself in person. So Jay, I'm going to start with you and kind of work our way back down the line here. So interesting question. When do you introduce the idea of an appraisal gap to a client? And how do clients react when explaining to them that people are paying over the appraised value?
There's crying and sweating.
All of us are just crying.
It's just a lot of emotion. It's definitely something that people are having to get used to, and it's a process. So I would say in a lot of cases, I may not be the one that introduces the concept of appraisal gap and paying over list price. They've probably had enough friends and family members that are real estate experts, that are aware of the fact that they're looking to buy a house and know everything that they need to know. So they're filling them in. Hopefully we don't have too many parents and grandparents letting them know they need to lowball that offer first and get a deal. So,
But isn't that what HGTV is for?
yeah, HGTV, that's awesome. So, yeah, like we should start a show that's like, this is real estate. It's dirty, it's ugly. So, but when I talk to people, I would say every transaction right now on our end, I feel, is much more high touch because we are helping people get used to something that they are just not going to be comfortable with. You have to step out of your comfort zone in order to buy a house right now. It's pretty necessary. So there's a lot more conversations, a lot more number crunching, a lot more questions, explaining things like bridge loans and recasts. It just takes a lot more time. It's a lot more to wrap your mind around. So it's not just, these are the two products that you can choose between, or, do you want to do your PMI this way or that way? It is a financial colonoscopy right now to go through the mortgage process. And, you really got to dig out some stuff that you didn't run a nose in there. So
I'll write that down. Financial.
So hope you all had breakfast already. So it's pretty much right from the gate. Just being honest with people about it is difficult for buyers, but everyone that I'm working with is finding a house eventually. So you've got to stick with it and talking to them about what I will do to try to give them every advantage they can have in their offer and just thinking outside the box to do that.
Absolutely. Anything to add to that, Mike?
Yeah, I think exactly what just Jay said. Right from the beginning, try to coach them on, if they're putting 20% down initially, then maybe they need to prepare for 15 or 10 or 5 or, all the different scenarios, not to bombard them, but also make sure they can clearly see, what the numbers are going to look like so they can know what to expect if appraisal does come in short and they have the extra cash, et cetera. So it is a lot of information, as we all know, from beginning to take in, and just trying to clearly show them that, and whether that be face to face, going back to the same question, or emails, et cetera. And it's more work, but it's what has to be done right now, because you don't want to not have that conversation and going in and wondering and not have a visual to see, because I'm a very visual person when it comes to the numbers, and I know what I want to see, and I try to give that to the same information to people. So knowing when to not go overboard too is also sometimes a challenge, because too much information, as we all know, can be a lot. So just same thing that Jay's echoed, but just really upfront, know what they're getting into, make sure they're comfortable, et cetera, and going from there. So
Sure. Thank you. Jason?
Yeah, definitely piggyback on what Mike just said. But I don't want to freak them out right out of the gate about a low appraisal and say, okay, here are the 17 different scenarios that may come up as a result of a low appraisal, because obviously, depending upon what the appraisal comes in at, that's how we're going to assess the situation and react accordingly. No, never. No, like 3 out of 15, maybe. Yeah, exactly. So, I obviously, my good realtor partners too, they prep the clients, obviously. They have this extensive conversation before they actually sit across the desk from me when it comes to the lending side. So those conversations have already kind of been vetted out. So they're prepared. But again, as Mike alluded to, it's at least maybe throw together a couple of different scenarios. What if the proverbial, what hits the fan, and the appraisal comes in, $50,000 short on a $250,000 sales price. That's going to be a major issue, unless what Mike alluded to, if they're putting a significant amount of money down. If you have Johnny first-time home buyer who has 3% down and is scraping money together for an inspection, that's going to be a scenario where normally they're going to be in a precarious situation and making up any sort of appraisal gap situation in that scenario. So, it's really assessing each client, on an individual basis to determine how to react and how to explain why you're paying $100,000 over what somebody's already listed the property for. That's already not going to appraise out. So.
Wow, it's tough to follow the three of you because I can concur with everything they're saying. I work very closely with our team of originators, and I know the one thing that resonated with me after speaking with most of them this week about this very topic, is just the excellent realtor partners that we work with have really done a lot of the prep work up front, but it's really a team effort between the loan originator and the realtor to make sure that the client really understands the situation that they're getting into. And then I know our originators always jump up and down when they see a property inspection waiver come through on DU, which is Fannie Mae's underwriting engine, obviously. But that depends on the structure of the file itself. How strong is the borrower? Do they have the right profile, and are the right comps out there with Fannie or Freddie to get that PIW or property inspection waiver? But it's also educating people on what that means too. Like, you can go this route, but you have to understand like what that means. You're not, if you don't want to go that route, you could always opt to get an appraisal. You need to talk to your realtor about that. But two, really being thorough and helping people understand, especially the first-time home buyers that are tied on cash. That's not an easy situation. But again, I think the partnership between the realtor and the originator in those cases really speaks volume to making sure that it goes smoothly and successful.
Excellent. Thank you. And I'm going to go a little off script here. Sorry, Chris. But in this, and you can just kind of answer as a group on this, are there any loan types that would not allow a buyer to do an appraisal gap? And if so, what are they?
Indiana housing. Indiana housing will not allow you to pay over appraised value. So that's the only one that I can think of. That
So really down payment
actually
assistance type
has a- Yeah,
programs.
has a guideline.
A lot of times the underwriter will want to see some sort of explanation or validation that they're willing to pay over list price for certain loan products as well. So, your VA, FHA buyers, they just want to make sure that that client is cognizant that they're in fact covering above and beyond the value of the property, and that the lender's only allowed to lend out lower of the two, acquisition versus appraised value.
Excellent. Thank you. And also for any of our virtual attendees, if you do have any questions, feel free to put those in the chat, and we'll definitely make some time to get to your questions as well. And same thing here towards the end. If anyone here has a question, we'll get to in-person questions. What has been a positive change or takeaway that you see in the mortgage industry or even your personal business since the onset of the pandemic? We'll start with Jason this time.
Wow. Positive change. It kind of goes back to, the efficiency. As some people who know me, I'm not the most organized person in the world. I'm more, I'm more of the front end rainmaker guy. So this fun pandemic we've been in has forced me to become, utilize more systems, embrace technology again. I know that's a boring buzzword, but that is the one, just becoming more efficient. My buddy Wickham, I've known him, I've been friends with him for probably 14, 13 years, ever since I've been in Indiana, and I'm always leaning on him. He's a systems guru, and I'm just trying to embrace being more systematic as a result of the pandemic, and being more efficient and going through loan applications. But as Jay alluded to, I'm a belly to belly guy, especially with your first time home buyers. It's not just like firing out a DocuSign and saying, sign this stuff, we got already appraisal, let's get going, that kind of thing. But unfortunately, in this crazy busy time that we're in right now, that's kind of the nature of the beast, where there's everything's accelerated and people are backed into a corner to make decisions they normally wouldn't make on one of their biggest investments of their lives. So to go back on a positive, it's just really, I'm appreciating this right now. I'm appreciating going back and having a beer at a bar right now, and just being around people, and you appreciate a lot in life when you get put in a really precarious situation that we all were thrown into the past year and change. So just looking forward to moving forward and being more organized.
So you've only been in Indiana 13 or 14 years, Jason? With an accent like that, I thought you were local.
The accent's creeped out, man.
Yeah, he manages the Wahlburgers.
Yeah. New career for Jason. Mike, I'll come to you next.
Thank you for your kind words. I am very systems-based, my checklist kind of person, get things done. So, the technology thing, going back to earlier, is really, it's been there, but you really incorporate that more with the videos we sent out, or the slide dial, all those crazy apps that you can use, really embracing that all the way through the process. And obviously DocuSign is huge. It has been huge, but getting on the phone or maybe doing a quick FaceTime or a quick Zoom to use that tool just to quickly go through the process, answer all the questions. Just the technology with everything is you either embrace it or you're not, or you're going to get passed by because everybody else is embracing it. So just trying to use that to the best of our ability. I do love face-to-faces too. Sometimes that has driven me crazy with not being able to physically meet somebody and talk to somebody, but I know our world is getting back to that slowly but surely, whether it be meeting at a Starbucks or our office or whatever the case is. So, but just continue to embrace technology, keep positive thoughts going out there, and just keep going after it.
Awesome. Julie?
Yep, I would agree. The technology piece has become really critical for us. We're a credit union that we serve members not only all over the country, but all over the world. So for us, we've always been very focused on technology, but it was a big shift and change for our entire team to go and work remotely too. We've been doing that now for 16 months, and it's actually been something that's been really, really good. I feel like the teamwork and the environment and everybody actually being more productive too and efficient with the use of technology. Our originators are doing what these guys are doing. They're meeting with Zoom, FaceTime, and actually meeting more often, I would say. So, you've got that first maybe initial in-person meeting, and then maybe you don't see them again, even though you communicate with them, you may not see them again till closing, but there seems to be more frequent virtual communication, which has been so great for our originators and for our team.
Jay?
All right, so cash flow has been much improved. I've appreciated that. So we all know that can change overnight, though, right? We've been around long enough to appreciate those good times and plan for the bad times. But technology definitely. Our company, we a couple of years ago started working on a new origination software and had kicked that change back through 2020 because of everything that was going on, just volume and all that. We kept our old system and we finally rolled it out this year in March. Kind of had to rip the Band-Aid off and just do it. And it was good timing. The software, it's definitely an improvement, although there's always a learning curve. But there's a lot of efficiency increase with it. And, it's allowed us to be efficient enough to do things like when someone's making an offer, run the property, put the actual property address in, and run the approval to see if I get an appraisal waiver at the time of offer, so that, we can potentially make an offer with the appraisal waiver if I've got everything from the client and really have the numbers and everything dialed in so that there aren't any real material changes on that transaction. It's surprising. The appraisal waivers have really been loosened up. The idea behind that during COVID was that they wanted fewer appraisers going into homes. And so the agencies have really loosened the screws on those. I expect that we will see a tightening of that at some point, but they've not. They've sort of delayed that. I think just because of what it is for the market and how the market is right now. But I've gotten appraisal waivers, a house listed at 515. I got appraisal waivers all the way up to 605 on that property. So it's not conservative necessarily. It is based on data. It is somewhat based on the client profile, their down payment, loan to value. But a lot of the appraisal waivers nowadays versus what they were back before the mortgage crisis are definitely looking at the data they have on that property and the area. You will not get an appraisal waiver on a new construction home. There's nothing in the agency systems from an appraiser. The data that they're using is collected by human appraisers. So every time an appraisal is done, and has been done for about the last decade, they've standardized those reports. It goes into a database with the agencies, and so they have all this human collected data that they have been amassing for a very long time, and that is what is being used to waive those appraisals. So you won't get it on new construction. You probably won't get one on somebody who hasn't gotten a mortgage, refinance, purchase, whatever on a property. If the seller hasn't mortgaged that property in a number of years, you're probably not going to get an appraisal waiver no matter what, because that property is not in their database. So, there are some things there that can help if you're listing a house and your client refinanced within the last couple of years, there's an increased chance that we'll get an appraisal waiver if the buyer's conventional and has at least 20% down. That's the gateway. It starts at 20% down on purchases. So the appraisal waiver thing is pretty huge while it lasts right now as it is. And just being able to run that if a lender's efficient enough, you may have to, if they don't get the property, you got to do what you got to do, withdraw the file, whatever. So it's, some work on the compliance side, but if you're efficient enough, it's just that extra work you can put into it to try to give your client that appraisal waiver up front, so they're one step closer to a cash offer, and give them that leg up where you can.
Excellent. Thank you. I think we're hearing a pretty common theme that we're seeing kind of a crossroads between technology and communication. And I think that goes for all of us, no matter what segment of our industry that we're in. And a lot of groups that I've been in lately, especially through the pandemic, they're asking, what's your favorite app on your phone? What are you using in your business? There's a lot of great apps. A lot of our business partners, as you know, have great apps out there. But I'll tell you, we all have this one app on our phone. It doesn't matter if you have an iPhone, a Samsung, but it's this little green dot that looks like a phone on it. It's the best app you can use. Call people. Communication is number one, no matter what the technology is. So don't forget you have that green button on your phone. I'm going to ask you guys to pull out your crystal balls here, and I'm sure that if you had $1 for every time you got this question recently, you probably could retire. So interest rates. What do you predict that the interest rate market will do over the next year? Of course, we're not holding you guys to any of these predictions because we know it can go any way very suddenly. But I know that everyone is curious to know what different lenders are thinking regarding the rate environment. Jay.
Yeah. All right. Is that better? All right. I might be I don't know if there's a bigger mortgage nerd than me, but I've got my ticker up in front of me all day long with mortgage bond trading and all that, and the financial news, and specifically how it breaks down to impact mortgage rates. So I stay pretty educated on this topic, and I expect interest rates to rise, but it's, we may see some peaks, but it's going to be pretty controlled. I think the Fed is really, really standing by their monetary policy. They're doing a lot of rhetoric to support the fact that inflation right now is transitory. It's a temporary issue. Inflation is, when there are inflation concerns, that is the worst possible news you can have for mortgage rates, for long-term interest rates. So the more you hear about inflation, the more pressure there is for rates to skyrocket. And so they're counteracting that concern with inflation with explaining that is sort of a temporary dynamic. We're coming out of this pandemic, and there's a lot of, there are shortages and different things. There are things that are contributing to a short-term spike in inflation. And so that helps support rates being controlled. And also the fact that the Fed is buying mortgage bonds. They are artificially keeping rates low. They have been doing that for a long time. They stepped it up during the pandemic to support our industry and make sure there wasn't a collapse and a lot of issues. There were some really scary days. So I see Mike Wood back there. You're at a position in your company that there were some real challenges to digest last year for mortgage companies. And, future in question of companies kind of questions. And we survived that. And so, those things are put to bed. We're seeing incredibly low rates that I never even thought were mathematically possible with everything that's baked into the margin on these things. They're here, and we're still seeing rates very close to these ultra lows. And, there will be some increases. There's nowhere to go but up. When I sit in front of people and they're asking about rates, I'm like, if something happens and rates drop again, what's worse than COVID? What's worse than the pandemic that we just went through? Like, I don't really want to be around for that. So I hope we don't see it. So I think we'll see definitely rising rates, but nothing too skyrocketing. Hopefully there's a lot of checks and balances in place to avoid that.
Awesome. I'm going to jump all the way down to Julie.
I agree. I don't even know how I survived last year. I'm sure you all feel the same way. It was just something I never thought we'd see during our lifetime. But, as far as interest rates, I never would have thought what happened last March would have happened. I myself was locking loans on the secondary market probably every 60 seconds. So it just a crazy, crazy time. And I agree with Jay. There's really nowhere to go but up. But, rates have stabilized here for a little while. You might see a little tick up, a little tick down, but I think, it will definitely be controlled, and it really just depends on the economy and the things that are going on out in the world.
Jason.
Yeah, to piggyback on that too, and what Jay mentioned, our friend Jerome Powell from the Fed, he's pretty much the guy that holds all the levers, and whatever he says, does create volatility one way or the other in the bond market. To what Jay said, he mentioned on Tuesday that he doesn't really see that they're still going to continue their tapering efforts in regard. They're not going to continue. I mean, they're going to hold off on that until the end of the summer. So they're still going to be buying bonds and keeping rates artificially low, probably to the end of the summer. So to answer your short-term questions, I think the summer we're gonna stay in this kind of environment where hopefully rates move sideways a little bit, but there's little blips here and there, but nothing compared to the scariness when the new administration took over and there was a stimulus and they pumped a lot of money into the system. That freaked a lot of people out, to what Jay alluded to. That's the inflation word. So when there's a lot of money being pumped into the system, bond markets hate that, and can cause a little tizzy in the market and cause rates to spike. There was probably about a week or 2 weeks where we saw rates almost overnight jump up about a quarter point or even a little bit more. And you guys don't see that on the back end, on the front end, but it kind of freaked out probably everybody sitting at this here. So basically, even like Jay mentioned, when I started in this business, we were doing double-digit interest rates, and it's completely mind-boggling to me when I have somebody asking me if they can get like a 1.9% interest rate or something like that. I just want to run through a wall sometimes. But and what Jay said too, the last thing, if rates go any lower than they are right now, I'd rather just be sitting on my deck having a cigar and calling it a life, because that is always normally good for the bond market when equities are crashing. So I think they're definitely going to go up, but I think this summer, I think the market's still going to be humming along, and we're going to have rates in the mid threes, low threes, high twos for at least at the end of the summer. That's kind of what the indication from Jerome Powell was on Tuesday.
Awesome. Mike?
I agree with everybody's opinions there. I think rates will probably stay relatively low or close to where they're demo. Take the rate that you have for the most part. I mean, they're still crazy low right now, unless, like if something happened, like Jay said, that would be horrific. So take what you have in front of you. I think rates will probably stay in the low to middle threes, maybe start to make their way up, but they tend to go up a lot faster than they come down. So, just take what you have in front of you and be happy that you have a, upper 2, low 3 rate. Those are great rates. So I'm not going to, I think everybody's already answered the question there.
Yeah, absolutely. And like I said, we're not going to hold you guys to those predictions, but I think they sound pretty solid on that. Next question. I think this is also a pretty common question that you may even be getting from agents as well. But how do you approach a conversation with a client that would traditionally have to go FHA due to credit scores, but obviously in this market they may need to look at a conventional product where they're going to have to maybe accept a higher interest rate or a higher PMI just so that they have the best shot of getting an accepted offer? How would you approach that? Start with Julie.
Yeah, I think it comes down to how badly does that borrower and client want the property. So again, that's it really comes down to a great partnership between the realtor and the loan originator. So we're relying on your expertise to know what's probably going to be a good acceptable offer in terms of financing for the property. And then it's really our job to make sure that we educate the client on those differences. But again, it really just comes down to if that's the best choice for them to get that property, then that's going to be the way to go. Doesn't mean they can't refinance in the future or get some different terms eventually. But yeah, it really just comes down to, do you really want this house or not?
Jason.
Yeah, that's to piggyback on what Julie just said. A mortgage, I mean, if you really look into the word, it's death. A mortgage is not a permanent situation. So if that person is like, oh my God, I have to pay $240 a month for PMI on a $200,000 house because my credit score is a 685, but that's the only way I'm going to get the house. You just need to reassure that person again, how badly do you want this property? Are you comfortable with the payment? When your score does go up, and hopefully interest rates stay relatively uniform, even if they go up a little bit from what they have, we may be able to refinance them to a more favorable conventional loan product, which will set them up better in the future. So it is a really tough situation and conversation to have with somebody in regards to FHA over conventional. Obviously, everybody in this panel, we always want to look out for the client's best interest. A conventional loan is always in the client's best interest long-term, most of the time. For the main reason is that with FHA, there's extraneous fees upfront that they have to pay to get an FHA loan. And also the mortgage insurance does not drop off an FHA loan. So depending upon how long they're in that house for, 9 times out of 10, if they're able to go conventional, that's always the best way to go because they can eventually get rid of that mortgage insurance on that loan.
So Mike.
Yeah, I think that there's plenty of borrowers that, like you guys attested to, that can go conventional, but there are borrowers that just cannot go conventional for whatever reason they have. And that's the challenge sometimes of, trying to educate them on why they can't go because maybe their credit scores just can't get to the point where the computer systems will take it. So what can we do to get them to that point where maybe they can get more of a gift funds or 401k loan, or they have equity in their house to try to get some type of bridge loan, if probably not with lower credit scores, but trying to find other alternative ways to see if they have other funds that can get them to maybe instead of a 3 or 5% down, they can go 10 or 15 or whatever the case is. So going through those conversations, but the reality is some of them might just have to wait and build their scores up or just know that if they go FHA, it might take a little longer, or they might be sitting on the sidelines for a while, but not everybody can go to conventional, but certainly we'll do our best to review everything, make sure they're, if their credit can get up to whatever they need to be through rescores or simulators or whatever the case is, try to go through that with them. But there are some people that just might have to just face the reality that FHA is their only option right now. Not that it's a bad loan, but they just might not have the ability to go. So,
Awesome. Jay.
My answer is going to be a little different on this topic. I want to stop having that conversation with buyers, and I don't want to have the conversation that I'm telling them that you can't take this FHA loan because you want to be able to get a house under contract. I want to educate the real estate community that an FHA financed offer is not a subpar offer in comparison to a lot of conventional offers. It is just as strong, and in some cases stronger. Conventional underwriting, automated underwriting has really tightened up during the pandemic, especially on lower down payments. And we are seeing a lot of files that I would look at and say, this is no problem, it'll fly conventional, that it will not approve, or very sensitive changes losing an approval on a conventional file, where I've got a lot more flexibility in areas to get that loan approved on FHA financing, and my financing is not in jeopardy if I'm going FHA versus conventional. So you may be looking at an offer that's conventional that is walking a tightrope, and the FHA offer beside it is golden, and you're electing to go with the tightrope walk. Why would you do that? So I think that doing due diligence on the offers that are before you is worthwhile. I think that it is a dangerous road to go down from a fair housing standpoint to say, I will not accept FHA offers on this property unless there is something about that property that is a problem for FHA standards, which are very few things in comparison to conventional. If you have an older property, pre-78, that has peeling paint, that's a problem for FHA. Now, I will tell you, a conventional appraiser can go out there and say, this could be a safety issue because it's potentially lead-based paint and it's peeling. They can make you scrape and paint on a conventional. But you're more inclined to have that problem, FHA, because there are drive-by inspectors that drive by these homes after an FHA appraiser has appraised the home. All they can do is look at the outside. And so if an FHA appraiser does not call out an exterior issue, that person is looking to justify their existence and they're going to call them out on it. So they know they have to call it out, even if it's minor. So there's not a lot of difference between property standards. The majority of the homes that we're selling are not a problem at all, whether it's FHA or conventional. And I think that there needs to be a lot more attention paid. FHA financing statistically is more common amongst minorities. And so there is, I mean, look up the channel, I saw it on channel 4, which is like CBS News. I happened to catch a report the other night with someone who filed a fair housing complaint here locally in Indianapolis because they didn't feel that their FHA offer was getting the attention that it deserved. So there is a push to say, okay, this is a high minority product. And if you're listing your house saying we're not going to accept, don't even bother submitting an FHA offer, that's a fair housing violation. So tread carefully on that and give them the attention they deserve because it might actually be a stronger offer.
Great PSA from Jay that we're going to get you on a speaking tour with that one, because I've talked to several lenders we've had the same conversation regarding FHA. So, and guys, FHA and VA offers are getting accepted out there too. So yeah, don't be afraid of them. So last question from me before we open it up to online and to here in person. What is one major obstacle that was created in your business due to the pandemic that you just really had to work really hard to overcome? Jay?
Volume. I'm not the world's biggest refinance guy. I do nothing to solicit refinances, but I've been in the business for 23 years. I've been with the same company for nearly 8 years, and people know where to find me. And so there was just a horde of interest in refinancing last year. And so balancing that with maintaining the attention that my purchases need, especially this year, there's still a lot of refinance attention vying for my time, and purchases just take, like I said, they're really, really high touch this year. So they take a lot of time, and I've got to be able to devote that time to purchases first, and just making sure that mentality is kept is really important. And just, I guess, the high touch, calculating things a number of different ways, showing someone that, alternative ways to cover an appraisal gap. It's not all about, do you have this $20,000 sitting in the bank that you could cover this gap? It's, okay, your down payment's 10% on a $400,000 house. If the house appraises lower, you could still put the same $40,000 down payment down, but now we're calculating the loan to value off the lower value. So now you're a 95% loan. So your PMI is going to go up by, $40. So it's not $20,000 more out of your pocket to cover the appraisal gap. It's a $40 payment difference. So just looking at alternative ways, that's been the challenging thing, is just the amount of time that you have to spend with clients versus the volume of work we're trying to do. It's long, long days right now.
Julie, how about you?
I think for us, it was, especially during the pandemic, how can we get loans closed efficiently? People were nervous about going to the title company. I know our title company partners did an excellent job, like working with us as lenders and realtors out there. But that's really, again, in our world, made us focus more on technology. We're in the middle of a big loan system conversion. We're converting our origination system so that we've got state-of-the-art technology, with e-closings where applicable, and so that we can make it just a smooth and efficient process for our members and for all of our partners as well. But, obviously it was a tough year, as we've all said. Our goal has always been to continue to focus on purchase business, but sometimes that refinance business comes from that purchase business. So it's really balancing that, but continuing to prioritize purchase and continue to educate people as much as possible about this current market and their loan options that are available as well.
Excellent. Mike?
I think the challenges that has been challenging for many of us is just meeting people, and more people, I would say, that are less technology advanced, maybe older generation that does not want to text, email, phone calls, or they want to meet. And I'd much rather meet somebody like that face to face. So going through that last year, at least the earlier part of COVID and middle part of COVID was a challenge, but adapting to that, obviously, as we all have, and also meeting or seeing our staff in the office. I mean, I know every office has adapted that a little bit differently, and working remote and not being able to see in our world, processors, underwriters sometimes, or closers, and just see how they're doing with their lives, and getting to see them on a daily basis has been a challenge. But that's all coming back for us in different ways. So those are the challenges, I think, for me there.
Absolutely. Jason?
The one main challenge is basically writing 10 to 15 pre-approval letters for one property on a Saturday. That's basically, because and just basically coaching people almost from a psychology standpoint to hang in there, and you're going to eventually get a house. Don't give up, unless within reason, they have to either, renew a lease or be homeless. But that's the one main challenge. It's just basically, we're doing a lot more work for the same transaction because they're just not getting the property. There's multiple offers, and we're just the real estate agents and the lenders are just kind of going through the motions a lot of times to put offers in on properties, because we're here to service the client and put our best foot forward to hopefully get them into a house and get them financing for that house. But to piggyback on what Jay said, I'm also a purchase-centric loan officer. I'd probably say about 85 to 90% purchase versus refinance. But again, I have a good sphere that if somebody's running into my office and they're on fire and they want to refinance their house, you're not going to tell them no. So I've always been wired, and my business motto is always getting back to people immediately and being super responsive. And that kind of, I struggled with that because you just can only talk to so many people in a day, and you prioritize purchases over refinances. But again, if they're there and they're people that have, went through you before, you take care of your people. I mean, that's how our business works. You take care of your people and they come back and they refer you. So, that's the main, it's just basically running a lot more loan scenarios, a lot more conversations, a lot more emails, a lot more text in order to consummate a transaction for, a buyer is definitely, it's a challenge because, and they're frustrated too. They don't want us to send 15 pre-approval letters for, and keep on saying, getting the answer no. No one likes that. It's not human nature to always be told no. So that's kind of one main challenge.
Yep, absolutely. I think a lot of us can agree that when the pandemic hit and things started to shut down, that we all thought that, our business was just going to tank, and we were mentally prepared for that. Then it was the complete opposite of what happened. So we had to really quickly readjust. It was almost a bit of a shock in a way. So I know that we're running along on time here. Any questions in the room? Mandy? So for those at home, Mandy's question was, how do you politely ask the buyer, if assuming that you're representing the seller, how do you ask the buyer if they offer an appraisal gap in their offer, that they actually have the money that they say that they have to cover the appraisal?
There's something called a pinky swear affidavit that you can have them sign. I think that's appropriate.
You get me? You good? No, I just personally, I don't get involved with that because I mean, I think obviously we can't send it over. So the agent and the borrower, the buyer's agent or borrower need to talk, you know, and the borrower needs to feel comfortable sending that over to the agent or the seller with their personal information. So I have seen offers come in with a bank statement and they, you know, X out or white out the account number, but that's really the route I would say you have to go with that.
Yeah, there's a fine line there with financial privacy and what we can and cannot disclose to third parties or interested parties in a transaction. So we're treading a very tight rope with that situation. But if the buyer is willing to surrender that information or disclose that information to their buyer's agent, and you know that they in fact do have you know enough funds to cover an appraisal gap, and then they physically put that in the contract, which I've been seeing a lot of contracts coming across my desk that are very explicit about how much that buyer is willing to pay. That's probably the best course of action to vet that out, because I know that is a sticky situation for everybody involved.
Yeah, I would agree with that too. You know, our mortgage loan originators have licenses. So we have to be very, very careful about the information that we are disclosing. We cannot tell our member or buyer that they can't disclose that to you, but that won't be a conversation that we encourage them to do. That at that point, we have to stay out of that.
Yep, and I would agree with that. Just from our end is, you know, whenever I've submitted offers that have had those appraisal coverages, I mean, list agents have not been afraid to come back to me and say, "Can you show us proof of funds?" Which I think is probably the best way. Or the offer's already coming in. You know, like I know one of you guys said that, you know, coming in already with a bank statement saying, "Look, here are our proof of funds as well."
I want to add something to that seriously. So pretty much every pre-approval letter that I'm involved with right now, we want it to be specific to the property. You know, we're trying to make that pre-approval as strong as possible. So we want the property address to be on there. This is what the realtors that I work with are wanting to provide. So I want to know if there's an appraisal gap being offered. The lender needs to know that. We need to have that plan. It's not always money in the bank that's going to cover that. It could be the same down payment, but just a loan to value adjustment. So it's providing a bank statement with, you know, showing all these extra funds is not always important. It's not always valid. So in my pre-approval letters, I will try to put a note in there that, you know, I've verified that they can cover the gap that's being offered between value and the price. So I want to be aware of that, and I want to address it in my letter. That way, I'm a professional saying that I've got the information to validate that this is good to go. And again, it may not be a bank statement that I can show you that's going to cover that. So that's kind of how I try to address that issue. And we don't need bank statements flying around. It doesn't really mean anything at the end of the day. You know, is that real or not? I know what a real bank statement is. But
All pages.
do you? All pages. That's right. So that's my take on it.
It's great. Awesome. Well, guys, it's almost 20 after 10. So thanks for sticking in there with us. I know this is a hot topic, a great conversation. I think it's going to be for a while. You know, if you have any questions for them after the meeting, I'm sure that, you know, they'll stick around for as long as they can with I know that your phones are probably been buzzing in your phone or in your pocket the whole time. So, Jay, Mike, Jason, Julie, thank you so much for giving up your time and for the great information today.
And nobody thanks Zach. Zach, thank you so much for being our moderator today. I cannot think of a better person to have doing this. So thank you. Just a couple of quick comments here. Cornhole, we are back. We did our first fundraiser and we set a record. More money raised in a single day event than ever before. The second best event was Steve Salerno's Broker Challenge when Teresa Conley was our chair. That raised about 5,200 or 5,300. We thought we raised 5,500. Grand Junction Brewing Company did a dine to donate. It's either $300 or $400, I think. So we'll go with 300 for now. $5,800 raised in one day. So thank you for everybody who is in attendance there. Don't mark your calendar yet, but put a little bug in your mind there. Volleyball is coming in August. We're, trying to zero in on the exact date and those details. So just be looking out for some emails and Facebook communications on that. The takeaways I got from today: face-to-face, old school, priority on purchase, and the importance of the realtor lending relationship has never been more important than it is currently. So if you're not friends with with your lender, then take them out. They should be taking you out for coffee or lunch. Let's let's keep building these relationships up, and so that way our clients get the best results. So with that, thank you so much for all your time this morning, and we will see you next month.